According to Pew Research Center, the American middle class has shrunk from 61% of adults in 1971 to just 50% today. That is half a century of erosion, and based on the economic data currently accumulating, the pace is not slowing down. According to the Federal Reserve's own Distributional Financial Accounts data, the bottom 80% of Americans by wealth now hold less than 9% of total national wealth. The top 1% holds more than 32%. The gap is widening every quarter. According to surveys by PwC and Bankrate, 78% of middle-class households are currently one financial emergency, away from genuine economic distress. One job loss, one medical bill, one car breakdown. Not a theoretical risk, a statistical description of where most middle-class Americans stand right now. This video presents the data behind 4 structural forces that are simultaneously compressing the middle class and the converging economic conditions building toward 2026 to 2028. The first structural force is debt dependency. The middle class has been progressively converted from a wealth-building class into a debt-servicing class. The numbers confirm the trajectory. In 1980, total American consumer debt, excluding mortgages, was approximately $300 billion. According to the Federal Reserve Bank of New York, total consumer debt has now crossed $17 trillion. That includes credit cards, auto loans, student debt, and personal loans. The average American household now carries over $11,000 in consumer debt. As of early 2025, consumer credit card debt alone has hit a record $1.2 trillion, according to the Federal Reserve Bank of New York. The average credit card interest rate has climbed above 22%, the highest level in the history of modern credit card lending, according to Federal Reserve data. Americans are not using credit cards primarily for discretionary purchases. Federal Reserve surveys consistently show credit card borrowing is being used for recurring essentials: groceries, utility bills, and medical expenses. J.P. Morgan Chase, Bank of America, and Citigroup together collected over $70 billion in credit card interest and fees from American consumers in 2024, according to their annual reports. Auto loan delinquencies, defined as payments 60 or more days late, reached their highest level since 2010 and 2024, according to Fitch Ratings data. Student loan debt stands at approximately $1.7 trillion, according to the Department of Education. 43 million Americans owe student debt. The average monthly payment for borrowers who are actively repaying exceeds $500 per month. The Congressional Budget Office estimated that the resumption of student loan repayments in late 2023 removed approximately $100 billion per year in spending power from 43 million borrowers, most of them in their prime earning years, age 25 to 45. The economic mechanism is straightforward. Debt service consumes income that would otherwise build assets, creates vulnerability to income disruption, and transfers wealth systematically from borrowers to lenders over time. The second structural force is the gap between wage growth and the actual cost of living. Officially, wages are higher in dollar terms than they were 20 years ago. The Bureau of Labor Statistics reported average hourly earnings growth of approximately 4% in 2024. But when wages are measured against the actual cost of housing, healthcare, childcare, and education, not the official consumer price index, real purchasing power for middle-income workers has been effectively flat or negative for decades. The home affordability data makes the gap concrete. In 1975, the median American worker could purchase a median-priced home for approximately 4 times their annual income. In 2025, that ratio in most major American cities ranges between 8 and 12 times annual income, according to National Association of Realtors and Zillow data. The monthly mortgage payment on a median-priced American home reached approximately $2,200 in early 2025, according to the NAR. In 2020, that same payment was approximately $1,040. It has more than doubled in 5 years. Wages did not double. The median American home price remained above $400,000 in the first quarter of 2025, according to the National Association of Realtors. At current mortgage rates of approximately 6.8%, affording that home requires a household income of approximately $114,000 per year. The median American household income is approximately $78,000, according to the Census Bureau. The math does not work for a statistically average American household. Childcare costs in major metropolitan areas now average between $15,000 and $35,000 per year per child, according to data from the Economic Policy Institute and state-level surveys. For a household with 2 children, childcare alone can consume 50 to 70% of one parent's entire after-tax income. The headline wage growth figures that are cited as evidence of economic health are also skewed by gains concentrated at the top of the income distribution. When compensation increases for high earners raise the average, the median, what the middle worker actually earns, tells a measurably different story. According to Economic Policy Institute analysis, median real wages for workers without college degrees have been essentially flat for over 2 decades when adjusted for actual living costs. The third structural force is the lockout from asset ownership. Home ownership has been the primary mechanism through which ordinary American families built wealth across generations. That mechanism is under documented structural pressure from institutional capital at a scale that has no historical precedent. In 2012, institutional investors owned approximately 2% of single-family rental homes in the United States. According to projections from the MetLife Investment Management Report, institutional investors could control approximately 40% of single-family rentals in the United States by 2030. Invitation Homes, a publicly traded REIT and the largest single-family rental landlord in the United States, owns approximately 85,000 homes as of 2025, according to its SEC filings. Blackstone's real estate portfolio spans hundreds of thousands of units globally. The investment logic is structurally different from that of an individual buyer. Institutional landlords price rent to reflect shareholder return expectations, not local wage growth. The combined effect is that families priced out of ownership by elevated home prices and elevated mortgage rates become long-term renters. And the rental market they enter is increasingly priced by institutional capital rather than local market conditions. The Federal Reserve Survey of Consumer Finances confirmed the trajectory. Median family net worth peaked at approximately $126,000 in 2007, fell to approximately $80,000 by 2013, and while it has recovered since, the wealth distribution has grown more concentrated at the top with each successive economic cycle. Research from the Urban Institute found that families who fall out of the middle class during a recession take an average of 11 years to return to their previous income level, if they ever do. With each successive economic cycle, the recovery path has become statistically more difficult to navigate. The three historical patterns that produce the current conditions are documented precisely. Between 1979 and 1983, the United States lost over 2 million manufacturing jobs, according to Bureau of Labor Statistics data. Steel mills closed, auto plants downsized, and the industrial Midwest, which had produced arguably the most prosperous working middle class in modern history, began a structural contraction that has never fully reversed. The unemployment rate in cities like Detroit and Pittsburgh reached above 20% during that period. The workers who lost those positions were consistently advised to retrain and adapt, while the systematic elimination of an entire category of middle-class employment was absorbed at the individual level rather than addressed structurally. Between 2001 and 2003, the United States lost approximately 2.7 million private sector jobs following the dot-com crash, according to BLS data. Unlike previous recessions, those jobs did not return in the same form. The phenomenon economists described as a jobless recovery took hold. GDP grew, corporate profits recovered, but middle-class employment did not return to pre-recession levels for years. According to Economic Policy Institute data from that period, the productivity gains from eliminating workers accrued primarily to shareholders and executive compensation rather than to the workers who remained. Then came the gig economy transition of approximately 2012 to 2015. A combination of smartphone technology, venture capital, and regulatory arbitrage created platforms that converted previously stable, benefit-providing employment into on-demand contract work. The J.P. Morgan Chase Institute analyzed bank account data and found that gig economy workers experienced income volatility more than 4 times higher than traditional employees. According to Gallup's 2023 data, approximately 36% of American workers participated in the gig economy in some form. The work itself did not change in many cases. The economic security attached to it did. The converging conditions building toward 2026 to 2028 involve 3 documented pressures arriving simultaneously. The first is the commercial real estate debt maturity wall. According to TREP and MSCI data, approximately $1 trillion in commercial real estate loans, office buildings, shopping centers, and apartment complexes originated at low interest rates is facing refinancing at significantly higher rates between 2024 and 2026. Multiple major commercial real estate firms have already entered distress or default proceedings. When commercial real estate defaults cascade, they affect regional and community banks disproportionately, the same banks that serve middle-class businesses and borrowers. The second is the ongoing spending reduction from student loan repayment resumption. The Congressional Budget Office estimated that the resumption of repayments removed approximately $100 billion per year in consumer spending capacity from 43 million borrowers. That reduction flows directly into slower consumer demand, which flows into slower business growth, which flows into hiring constraints. The third is the documented and accelerating displacement of white-collar middle-class work by artificial intelligence. Goldman Sachs published research in 2023 estimating that AI could automate tasks equivalent to approximately 300 million full-time jobs globally, according to the report, The Potentially Large Effects of AI on Economic Growth. The McKinsey Global Institute published analysis finding that between 3% and 14% of all workers globally, potentially up to 375 million people, may need to change occupational categories entirely by 2030. Not update skills within the same field, but change categories. MIT and Boston University research by economists Asamoglu and Restrepo confirmed that industrial robots alone had already significantly reduced employment and wages in affected communities over the prior 2 decades. The occupations most exposed to AI displacement are not the ones most commonly cited in public discussion. They include customer service, paralegal work, basic accounting, medical imaging analysis, and the full layer of administrative and analytical work that constitutes the modern white-collar middle class. The 3 pressures, commercial real estate stress affecting regional banks, spending reduction from debt repayment, and structural AI displacement of middle-class employment, are arriving in overlapping timeframes rather than sequentially. The education credential data deserves specific attention because it sits at the intersection of the debt trap and the wage illusion. According to College Board data, the average cost of a 4-year public university degree has increased over 1,300% since 1978. According to Economic Policy Institute data, the average starting salary for a college graduate has risen approximately 19% in the same period in real terms. A 23-year-old carrying $80,000 in student debt on a $42,000 starting salary is not building toward middle-class wealth. That person is servicing debt acquired in pursuit of a credential whose economic return has not kept pace with its cost. The Federal Reserve Bank of New York's research confirms that the college earnings premium has been declining. The credential that historically functioned as the middle-class escalator has, for a growing share of graduates, become the first stage of the debt dependency cycle rather than the exit from it. 5 specific and data-supported actions are consistently identified by financial researchers as protective against the structural pressures described in this analysis. The first is the aggressive elimination of high-interest consumer debt before the next economic disruption cycle arrives. Consumer debt at 22% interest, the current average credit card rate per Federal Reserve data, is the most direct drag on household wealth accumulation available. Paying off a credit card balance at 22% is the mathematical equivalent of earning a guaranteed 22% return on that capital. No standard investment vehicle offers a guaranteed return at that level. The second is extending emergency fund targets from the traditional 3 to 6 months to 12 months. The Urban Institute's finding that middle-class families take an average of 11 years to recover from a downgrade event suggests that the traditional 3-month emergency fund was calibrated for a labor market where replacement employment arrived quickly. In a labor market where AI displacement may require retraining periods of 12 to 18 months, 3 months of savings is a short runway. The third is deliberate investment in skills that current AI systems cannot readily replicate. Complex human judgment in unpredictable environments, skilled trades requiring physical dexterity and adaptive problem solving, high-trust relationship-based professions, and original creative synthesis. Licensed electricians, plumbers, and HVAC technicians represent categories where AI substitution is not technically feasible on current or near-term timelines. Occupations that combine technical knowledge with direct human judgment rather than routine technical processing represent the labor market segment least exposed to the displacement documented in the Goldman Sachs and McKinsey research. The fourth is consistent low-cost index fund investing through tax-advantaged accounts, 401k or Roth IRA, at whatever contribution level is accessible. The compounding mathematics of consistent long-term index fund contributions are not dependent on market timing or sophisticated financial knowledge. They are dependent on time in the market and consistent contribution. The fifth is reducing single income stream dependency, ensuring that the loss of any single income source does not immediately threaten housing stability, given the income volatility the J.P. Morgan Chase Institute has documented and the displacement risk the McKinsey and Goldman Sachs research has quantified. The international comparison data adds a dimension that domestic coverage of this issue consistently underweights. The United States is not the only advanced economy with a middle class, but it is the only major advanced economy where the middle class has shrunk this consistently over 5 decades, while GDP per capita continued to grow. In Germany, co-determination laws require worker representation on corporate boards, which structurally constrains the degree to which productivity gains can be redirected entirely to shareholders without a proportional increase in worker compensation. In Denmark and Sweden, collective bargaining coverage exceeds 80% of the workforce, meaning wage growth is structurally linked to productivity growth across the economy rather than concentrated at the top. None of these comparisons are ideological arguments. They are data points that isolate the variable. The institutional structures that connect economic growth to middle-class prosperity are not automatic features of a market economy. They are policy choices. And in the United States, according to the documented record assembled by Pew, the Federal Reserve, and the Economic Policy Institute over 5 decades, A specific set of structural shifts have produced a specific outcome: economic growth that has continued while the middle class has contracted. According to Gallup longitudinal polling, Americans' satisfaction with the availability of good jobs has tracked closely with median real wage growth. Not GDP growth, not stock market performance, not the unemployment rate, but whether the jobs available pay enough to maintain middle class status. Thank you for watching our analysis. Please share your thoughts below. Subscribe for breaking news updates, turn on notifications for alerts, like this video if informative. Comment your analysis and predictions. Share with friends and family. Stay informed about global developments. Follow us for exclusive content. Your engagement helps our journalism.